Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Afif. So today I'm going to talk about Sukuk issue revolving around the accounting treatment.
Basically, it's a fixed income instrument. It is an IOU between the lender and also the borrower. As you can see from this transaction, the investor will pay $100 in the beginning and receive that $100 plus the interest. And throughout the year, they will receive the dividend, $5 there. And what is Sukuk? Sukuk is basically an investment certificate, a trustee certificate. It is a transition from the bond itself, but it needs to be backed with the assets such as tangible asset or services, or even as a usufruct to benefit from it. And it is a form of written financial instrument. While from the Sukuk, from the IOP point of view, it is an ownership of the tangible asset, usufruct, and services of the ownership of the asset, particularly in the project or an investment activity. So, in conclusion, it is an evidence of the ownership.
There is a difference between the IOP and IFRS code, which the IFRS will provide the financial position, performance, and the changes, which can be seen. They are more highlight on the financial effect and risk, not merely the legal form, which can be indicated as a substance of a firm, while IOP is opposite of it, because their main objective is need to be fair reporting, which reveal what is halal and haram, and it will reveal the asset identification, legal form. So basically, it's more on form over substance. From the religious point of view, IFRS is more on religion neutral, while the IOP is more on Islamic friendly. The representation of the IFRS between the bond and Sukuk are similar. From this part, as you can see, there is operating income, interest expenses, and net profit. While for this one is for the Sukuk. Operating income, financial expenses under Sukuk transaction, and net profit. Basically, both of it are the same, except that they change from the Sukuk and the bond. And let's go for the next part, which is the cash flow statement and the balance sheet. As you can see right here, the financing transaction proceeding from the issues of the bond, the cash used to redeem the bond, and for the balance sheet is the bond liability. While for the Sukuk, it's basically the same. For the balance sheet is liability under the Sukuk financing transaction, while this one is an payment of the Sukuk financing obligation. So what I can conclude is both of it have the same structure due to the same goal, which is the IFRS want to highlight more on the economic effect. It's more on the IOU instead of what is it supposed to do, which is the ownership of the asset itself lah. The effect of the IOP, which is, as you can see from right here, the trader placed the report of sale of the building at the beginning and purchase back at the end. As you can see right here at the red column, proceeding from the sale and buying building, and also net cash from the use of the investing activity. So as you can see right here, it's quite clear, there is a changing of the ownership. While from this part, it's more on financing, proceeding from the Sukuk financing transaction and payment of the Sukuk financing obligation. This one is from the IFRS point of view. And the next part will be no financing liability aversion inside the Sukuk transaction. Since there is a changing of the ownership, as you can see right here, there is no financing liability, but instead it shows the shareholder equity. So it's more on purely the ownership of the Sukuk itself, while from the IFRS point of view, there is a liability under the Sukuk financing transaction. Since there is a changing of the ownership, so basically the IOP part, there will be a record of $5 renting, which can be seen from the bond, which is the dividend throughout the years, payment of the rent, and all of the 110 paid at the end recorded as the acquisition price of the new building, as you can see right here. While for the IFRS, there is no renting right here, and also there is payment of the Sukuk financing obligation instead of the purchasing of the building itself. So that's are the main difference. As you can see, Jima is power as the MBHD Sukuk Murabaha, which is based in Malaysia. There is no sale or buyback or even rent inside their accounting, while it is more like a commitment of IOU, Sukuk profit payment, and so on. Even until the end, there is no changing of ownership.
In conclusion, as you can see, the Sukuk is basically an ownership of the certificate. The way that it is represented is based on the objective of the standard, but at the end of the day, it's a form of communication. Since IFRS is more focused on the economical effect and the risk, we can see from the Rabul Mal point of view, the money that lose, which is a financial liability, instead of the IOP, is more highlight on the asset liability, since there is an existence of the changing of the ownership. So what I try to say is, it is better for us to use the IFRS standard, since it is a lingua franca for the business and investors, without it actually erase the value of the Sharia, which is the changing of the ownership itself. So you need to differentiate between the bond and also the sukuk. So that's all for today. Assalamualaikum.